Some people are remembered as legends in the financial world, but others are remembered for the wreckage they left behind. For many years, Bernard Madoff was seen as one of the brightest stars on Wall Street. He was a reliable investor, a devoted family man, and a respected figure among financial geniuses. But behind the scenes, the scheme he set up turned into the biggest financial scam in modern history. Bernard Lawrence Madoff was born on April 29, 1938, in Queens, New York, to Ralph and Sylvia Madoff. His father, Ralph, was a Polish immigrant and a plumber who worked tirelessly to support his family, while his mother, Sylvia, of Romanian and Austrian descent, was a homemaker. The couple married in 1932, during the depths of the Great Depression. Growing up in financial hardship, Bernard had to work throughout his life. From a young age, he developed a keen interest in finance while also excelling as a professional swimmer on his school's team. In his spare time, he worked as a lifeguard in Long Island, saving his earnings for future investments. After graduating from high school in 1956, Madoff enrolled at the University of Alabama, but later transferred to Hofstra University in Long Island. In 1959, he married Ruth Madoff, his high school sweetheart. At the time, the financial world was entering a new era. In the early 1960s, Madoff invested his savings and borrowed money from his father-in-law to launch Bernard L. Madoff Investment Securities. His father-in-law, a retired financial advisor, helped Madoff gain credibility, and soon, his firm attracted a growing number of investors. His client portfolio expanded rapidly, including high-profile names such as Steven Spielberg, Kevin Bacon, and Kira Sedgwick. By the late 1980s, his firm was handling over 5% of the trading volume on the New York Stock Exchange. Madoff's biggest allure was the promise of stable and consistent returns, regardless of market conditions. Despite the natural fluctuations of the financial world, Madoff's investors never seemed to lose money. Even when the stock market performed exceptionally well, Madoff capped returns at a fixed rate. This perceived stability made him a safe haven for investors. However, in reality, Madoff was simply operating an enormous Ponzi scheme. By 2001, Madoff's claims of consistent returns were beginning to raise suspicions in the financial world. Forbes magazine published an article questioning the transparency of his operations. Financial analyst Harry Markopoulos conducted an in-depth investigation, producing a 2005 report titled, "The World's Largest Hedge Fund is a Fraud." However, Madoff's influence and reputation shielded him from scrutiny. For years, he successfully evaded regulatory oversight and continued deceiving investors. Madoff's Ponzi scheme operated by using new investors' money to pay returns to earlier investors. The hedge funds he claimed to be investing in didn't actually exist. As long as money kept flowing in, the scheme survived. His fraudulent empire spanned North and South America, Europe, hedge funds, banks, Jewish charities, and countless individual investors. Madoff managed to suppress dissenting voices, maintaining his illusion of success until 2008. The global financial crisis of 2008 marked the end of Madoff's Ponzi scheme. As panic spread, investors rushed to withdraw their money. Unable to meet these demands, Madoff had no choice but to confess. On December 11, 2008, he was arrested by federal authorities. Madoff admitted to investigators that he had lost approximately $50 billion of his investors' money. On March 12, 2009, he pleaded guilty to 11 felony charges. Prosecutors revealed that over the years, a total of $170 billion had passed through Madoff's main account, and at the peak of his fraud, his firm's statements falsely showed a balance of $65 billion. Ultimately, Bernard Madoff left behind millions of victims and orchestrated the largest financial fraud in history. His downfall left an enduring mark on the financial world, serving as a stark reminder